Property investors are reacting strongly to the tax changes being discussed for 2026. Across Australia, conversations around negative gearing and capital gain tax are creating a lot of uncertainty. You've probably heard things like negative gearing is dead. CGT is going to kill property investing. But the key issue is this. A lot of the discussions online is mixed confirmed information with assumptions. And even though there is factual information around it, people still are not able to comprehend what it actually means. So let's break this down properly. Hi, I'm Anubhav, founder and director of Find My Real Estate, a leading property buyers agency. And in this video, I'll explain what currently is being discussed, what actually is being spoken about, and what investors should pay attention to. No hype, no loopholes, no get-rich-quick schemes, just talking about what this actually means when we talk negative gearing and capital gain tax. What could this mean for investor return? How to evaluate property decisions in this environment? First, separate confirmed information from just commentary. Lots of news are being floated around and fear that's been instigated through the media. At this stage, the discussions that we are talking through, negative gearing, capital gain tax, and broader policies that are about to change or will change, does not mean that this will impact property. And importantly, there is currently confirmed no policy change that we have seen, but this may all change very soon on Tuesday when the budget is going to be released. That claim has circulated widely online, but it is not about any confirmed legislation just yet. The proposals most commonly discussed publicly include limiting negative gearing to newly built properties, reducing the capital gain tax discount from 50% to lower rates such as 25% or even 33%. Now, whatever the number is, it does not matter. My question is that if you made money and you have to pay tax, what's the problem? So before making major investment decisions, it's important to recognize the policy settings being discussed are evolving and will continue to bring position in Australia that will still allow people to invest confidently. If an investor makes $500,000 in capital gain and has to pay capital gain tax on top of it, be it 50% or 35% or 25% or 33%, how does it matter? You're still making money paying tax on dollars that your property has earned in equity, and it's not coming from your pocket. It's money that you're going to get from the actual growth which you're going to pay out of that. So who cares how does it actually work at that point in time? You need to make sure that you understand the full picture and it's in front of you and it's meaningful when you're doing your numbers. Let's say you have no investments today and these changes apply. What does this mean in 5 years time from now? It actually means that you're holding a portfolio that's going to grow over a period of time if you bought in the right area. And if you've had your properties go up 50%, 60% in 5 to 7 years, what that actually means is you've actually had growth for you doing nothing, but your property is actually performing well in that market. Now, if you have to pay tax on it, how does it matter? You've made money out of it. This did not exist. Assume if you did nothing for the next 5 years and all you did was relying on your 9 to 5 income, would you have made that money at all? Absolutely not. So think beyond height. Your income, your long-term strategy, whether the property is being held long-term or sold, cash flow, borrowing considerations, and broader tax hack. How do I make use of the current law that's going to come in, and how do I apply that to my strategy is your number one priority before you actually even go and buy a property. In the short term, some investors may delay purchases, right? And that's okay. Market sentiments may soften temporarily, and that's also okay. But for the longer term, housing supply remains constrained. Demand is extremely high. Population growth continues to increase housing demand, which means doesn't matter what the tax policy changes are, you possibly going to be investing in markets where people need real housing to live in Australia. With war going around us and so much uncertainty globally, you're already experiencing that uncertainty in Australia. But that creates more uncertainty for global markets, and they find safe haven countries to live in, which means it puts more pressure on people coming into this country and living here. That means more population boom with less housing available in Australia in the right areas. So focus on asset quality, manage borrowing carefully, think a long-term plan, and have the right team working with you who can talk about taxation, borrowing capacities, and then making sure your portfolio is growing with a very balanced cash flow, that's going to allow you to create wealth seamlessly. So before you make your next move property decision, make sure you understand the numbers, the structure, the long-term implications behind it. Because if you want, I can also break down the real investor scenarios before and after the proposed tax changes, which I definitely want to do once we really know what's been the play with the government. Yet, don't hold. This is your opportunity to make this work when everyone else is fearful. Watch this channel and speak to us if you really don't know how to bring clarity into your portfolio. Find My Real Estate can help you find the right properties. And even in this environment, we are seeing people making 15 to 20% growth every single year.